trading at approximately 846 points. How come? December. This I'm making a video in April. Hi everybody, today I'll show you how one pool of capital can work at two different places at the same time. We're gonna discuss about leap option strategy. We're gonna talk about marking crashing down 20, 30, 50%. We're gonna talk about massive gap ups. You've been requesting a lot in the comment section because you know that if a leap strategy video coming on this channel, that means what exactly? If you are in short of time, I request you to completely skip the video. But if you commit to learn this leap strategy which I'm sharing with you, make sure to watch it till the end. Because remember, 1 rupee doing one job is a lazy money. Let's talk about where the Nifty is at the moment. And then together, you and me gonna talk more. We're gonna make a strategy together. So here we are on a Nifty daily chart. Just see the amount of fall. Market from 26,500 has gone as low as 22,200. That much of a crazy, massive move in Nifty, which you can see. And obviously, there is some amount of retracement, which you can see. Now, what maximum traders think at this point in time is that mutual fund sahi hai. And the normal common wisdom is when market has fallen so much, a lot of people probably look to average or initiate their buying or, being optimistic about the market. I'm gonna show you step by step. Let me load an Excel and things will be crystal clear today. So here we are on the Excel now, and what is the most common option which a lot of people may consider mutual fund sahi hai, etc. Right? What is Nifty trading at the moment? Approximately 23,800. If you multiply that by lot size, it comes out to be 15,47,000, rounding off to 15,50,000 approximately. So a lot of people look to long Nifty ETF equivalent to the future size क्योंकि वो उसको hedge कर सकते हैं, etc. So I'm just taking a standard size of 15.5 because Nifty has gone down, etc. Now the problem starts now. The problem is if market go up, then it's fine. If market do not go up, then there is problem number one is there is no crash protection. What if market go down 10, 20% more? What if market go down 50% more? Then what will happen? The capital will become half. Problem number two. Capital is blocked now. 15 lakh is not a small amount. That amount is blocked. Maybe people buy 5 lakh, 10 lakh, 50 lakh, depends on the pocket size, but the amount remain blocked. Is that a very smart thing to do? Is that a very intelligent thing to do? Is what I'm going to throw some light on. Problem number three, sideways, no gain. What if market do not go up, market do not go down, market stay where market is? Then we're going to lose time. And there is no return as well from ETF. So the popular option, these are the issues with this. But if market go up, then naturally the ETF look to gain some value. I want to add one more option on top of it. And after that, one more option. And after that, one more option. What can we do? Let me load that. Option number two, instead of longing ETF and blocking 15,50,000 rupees on an ETF, what if Nifty future is longed instead, right? Because ultimately, when we long future, it mimics ETF, obviously, right? If market go up, ETF go up, future go up. The benefit here is that longing a future cost around 1,85,000 approximately. Let's round it off to 2 lakh. So if we long 2 lakh, we are getting somewhat similar advantage. It's solving our purpose. Plus we are saving 13,50,000. Remember from original 15.5. Instead of holding 13.5, why don't a trader consider doing a fixed deposit of that amount? So future is long plus the remaining amount fixed deposit. Now, why do we do fixed deposit? We do for 6 months, 1 year, depending on the time horizon. Fixed deposit is done, so the money does not sit idle. It makes some kind of a return month to month, quarter to quarter basis. Does that solve a purpose? Now, let's talk about the weaknesses which you were discussing. Now, if market goes sideways, nothing happens in the market. For example, fixed deposit is not dependent on the market. It's a debt instrument. All of us know this. So that problem is not much of a concern now. At least 13.5 is getting rotated in debt instrument, fixed deposit. Number two, if market go up, remember the earlier, if market go up, the ETF gains value, Here we already long the future, so market go up is not an issue for us, obviously. But if market go down, then the future gonna bleed very, very heavily. Then what to do? Interesting. Here I have option number 3 for you. Before I reveal an option number 3, have you liked the video so far? How would I come to know that you like this content? And most importantly, do you understand this? Because if you understand it, that motivates me to make even more advanced videos. That's why you come on this channel. Let me show you option number 3 now. So here option number 3, what else we could do? Instead of ETF, we long the future, obviously. Rest amount is saved, we do fixed deposit. But a lot of people may consider that why don't we buy in the money or at the money put? Let me show you what at the money put is trading at the moment. You want to see that monthly put, right? So here we are on an option chain, and this is the monthly put at the moment. And what do you see? This is trading around 450 approximately. Which series have I picked? I've picked the monthly series, right? Look at the transparency. Transparency is here. And not transparency, you also have an option chain, right? You can check it out. You see monthly option chain at the money, around in the money is trading around how much? Approximately 400. Now remember that. I'm going to do an entry on Excel. It's approximately 400. The real pricing is 130, 140 approximately. So 400 is at the money put. Now here, the advantage is that if market go down, suppose market become example, right? Stock market, anything can happen. Overnight market can give circuit, etc., etc. You know the fall. All of us have seen what happened in previous month. Now, if market go down, this gives you some kind of a cushion. But the problem is, this is too damn expensive, right? It's around 400 points. Very, very expensive put. The theta decay is a lot faster. Upside, no issue. Sideways, no problem because of fixed deposit, right? And if you think this is it, this is the max we could do, you wait. I'm going to add one more layer to this, option number 4. And by the way, I've made a video, I guess, 10-15 days back about covered call. Highly appreciated video. If you haven't seen that, you must see that right after this. Maybe I can put a thumbnail here. Very interesting. But let me teach you, option number 4, what is the real meaning of hedge today. Adding one more layer, and with every layer we try to make it more powerful. Now here, everything same. Instead of ETF, we understand that future makes more sense. There's no point blocking 15.5 lakh, right? And then rest amount in FD same. But here the difference is, instead of buying ATM put in the current month, which is so expensive, why don't we buy December? Now you must, how many of you check December contracts, right? Very less people check it. Would you believe if I show you that December around at the money is trading at what price, right? Let me load option chain and I'll show you. So here we are on the option chain right now. And what you see is market is 23,800 approximately. And around at the money is trading at approximately 846 points. How come? December, this I'm making a video in April, 840 points. And you want to see this is December, of course. I'm going to show you. We go up and what do you see? December 26 contract. Let's go to Excel now. And you know what we're going to consider? Instead of doing that, if I long December contract, my future is in place. Obviously, when I long future, I got to roll it every month, or I could just roll next month. And then in 2 months, I got to roll it. Obviously, that depends. And cost of brokerage, etc. Please don't put it in the comments. Brokerage is a business cost, which everybody pay. I pay, everybody pay, right? So 20 rupees brokerage, etc. We're not here to talk about that, right? This video is not for that who wants to save like 2 rupee, in brokerage or STT. That's a part of cost of doing business. These are the taxes. That's what it is. Trading at 800 points. Now let's calculate here. Now, long Nifty future. Bought December put. Here the simple calculation is that suppose if we long the future, but this time we long December put, which is approximately at the money, and this is trading approximately 840 points. Now if market go down, suppose market go down to 16,000, if that happens, sort of a market crash, then what do we expect is that the put which we bought is expect to be in the money. We bought a 24,000 put, market go down to 16,000. So naturally it's going to be 8,000 in the money, simple maths. When we add everything, naturally the future should be in losses because we long the future. We long the put, so that expect to be in the money. So when we add everything and we see in terms of rupee terms, if market really crashes and we find ourselves minus 41,600, I'm not talking about small fall, I'm talking about a fall of approximately 7,800, 8,000 points fall from the current level. But can we do something more in this? Can we even try to add one more step to this if market crashes? The answer is absolutely yes. Let me load another step and I'll show it to you. Here in market crash, is it possible that suppose if market go down, like I said, 16,000 and we did our calculation, what do we find ourselves is that this put which we bought at 840 is now 8,000 because that's in the money. So in terms of rupee terms, this put is at profit of 4,65,400. Now, when the market has gone down so much, listen to this very carefully. Future is obviously already in losses. Now, can't we square off this particular put? And can we use the same margin by longing the put now when the Nifty is trading around 16,000? Suppose market go down to 20,000, for example, right? If I just show you here, 20,000. In that situation, what's going to happen is going to be 4,000, obviously, because it's going to be in the money. Now, the put itself, we're just talking about this particular leg. This is approximately is 2,05,400. Can't we square off this particular put completely out from the market? It takes approximately 1,85,000 rupees to long a future. And now if someone try to long the future, then the average pricing has gone down. And if any kind of a brutal fall, God forbid, if market go to 14,000, in that situation is going to be 10,000, obviously. Now, this put alone is covering a lot of ground for us. The idea is, if market go up, suppose if market go to 28,000, right? Example. And this put is naturally gonna become zero, then net, what do we see is we find ourselves 218,400. So upside is here for us. Upside is not an issue. But if market go down, we bought the put becomes in the money. We use the same put to buy more future. So the average price ultimately go down. Now, long more future, and obviously we already have some capital which is already in debt. That is, for every month we are trying to get some kind of an interest that is already doing its job for us. The put is already doing its job for us because market has gone down. The future is doing its job for us because we are using the put which is now in the money to buy more future at a lower level. Think about this. How interesting this can be. And I have some more points to add to this, which I'll do it now. VIP point number 1. Debt is equal to tax supply. Remember I told you that it's a hypothetical example. Obviously, you plan to long it or you plan to short it. It completely depends on your view. I'm just showing you how math's supposed to work. But there are some gaps here which I like to tell you, because this channel is not one of those channels where I just tell you all the positives of it. I've never done it. I'll show you the negatives first, and how do we tackle the negative into positive is what the name of the game is. So obviously, when we deploy certain big amount of capital in debt instrument, any debt, that obviously attracts some amount of taxes. That's obviously a cost of doing business. So you must calculate beforehand. Do not just take the figures on the Excel just on the face value. They're going to be brokerage charges and some other charges as well, as you know it. Also, remember, we are longing the future. We cannot long December future, so we are longing current month or the next month. That is something which we got to, roll it every month or every 2 months. That will have its own cost. STT. I've told you about STT, how we could, take benefit of STT. I've made a video on that. I mean, if you just simply keep on rolling the future, that costs around 800 rupees of STT. But there is one method which I shared. How do I pay 50 instead of 800? So that's a 750 rupees saved. So that video I've made, a very interesting video. You can watch it. Number two, when to book hedge profit, when to redeploy. Maybe I can come up with part two if there is a lot of request. When should be the ideal time? When would I look to deploy, cut my put and long the future? What level? What level would I try to do it? And can we do something more with this? That is something interesting. I'm hedged, but I can oversize. Don't. Do not oversize any position, right? And calculate the cost beforehand. It's important to know. In reality, many freeze during crashes and do nothing. Well, having a plan is different. Having a mentor, having ready-made strategies is a different ball game. But executing it when the market is really crashing, just imagine for a second if market is really crashing, a lot of people freeze. They forget the plan. That should not be the situation, right? We should know exactly when to take an exit. Maybe something can happen above and beyond, which is discussed in the video. If that happens, in that situation, we can completely exit the position as well, right? Number one is we should have a proper plan, a solid plan. And number two, we should know how to execute that plan flawlessly. That's the exact reason I tell you, hit and trial way of trading, one must completely avoid into the markets. It's about the strategy, it's about the execution, and there are a lot of moving parts to the hedging concepts. I'm sure you must have learned a lot from this video. Now I'm thinking a couple of more things which I can do with the ETF, but probably we're gonna leave it for another time because I don't want to give you so much of information in shortest amount of video possible. Now you've watched it. Make sure to share it and also watch the video which I made about the covered call just a few days back. That's very interesting. You're gonna learn some things from that video. I want you to do really well. Thanks for watching. I wish you all the best. Take care, signing off. Bye-bye.